All right, ladies and gentlemen, in this brief video, I'm going to introduce you to the CurveFly trade in the platform. Every now and again, you come across a trade that's easy to read, that's intuitive, that's based on logic, that's risk controlled, and think to yourself, that's easy. A 12-year-old could do that trade. This is that trade. Okay, now who is this for? This is for those of you who already trade bonds, treasury bond futures. These are for those of you who are considering trading treasury bond futures and want a simple way to engage in this market, to learn it, to observe it with very little risk. Okay, 10 to 12 ticks, just so you're clear. This average risk on one contract is $78. $78 per trade. And look over here at the P&L. A typical move is $280. Okay, so it's almost a 4-to-1. It's over a 3-to-1 in almost every situation. And these trades come about once every, sometimes they only last a day, but a typical trade will last 2 or 3 days. So if you trade one of these prop accounts, you'd have to close it out and then get back in. But this, if you trade one of those prop accounts and you are already funded, this is definitely something you should take a look at because it is a smooth equity curve. It's based on logic. It doesn't involve guesswork. It doesn't involve subjectivity of staring at a chart. This is based on real logic. This is a very professional institutional trade. Let me stop rambling and get right into it. This is the middle of the yield curve. This is an important, essential part of the U.S. and the world economy. All right, this is the curve that takes place between the short term and the 30-year bond. We are now in a steep, and by the way, if you are a serious bond trader, let's have a conversation because these tools with the new steepener, flattener, and the analytical tools for spread traders is just fantastic. So let's get back to this, the CurveFly. What is it? I'm trading the belly of the curve. I'm trading the middle part of the curve. I could teach a 12-year-old this trade. The purple goes below this 0 horizontal line. The blue goes above the horizontal line. And what do? I trade the white line, which is the ZF. That's the 5-year treasury bond, right? That's the middle part of the curve. Very simple. Conversely, interest rates go down. Boom, there's the 5-year. I can go long the 5-year. I can go long the butterfly, or I can go short the Tiffany. I call it the Tiffany spread, all right? The CME called it the TFY. They currently replaced it with the tough spread. If you're a bond trader, you know what I'm talking about. I'm going to talk to you like you're 10 years old. That's how I like things explained to me when I'm learning. Very simple. I'm going to buy this white line when the purple line's above and the blue line is below. I am going to short this white line, the 5-year bond. Here's the 5-year bond. Here's price. I'm going to short it when the magenta line is below, purple, magenta, you pick, and the blue line is above. Why? Why am I doing that? Just because it's simple to see graphically? Partially. The real reason is that it's easy to discern graphically because there's actually something going on in this middle part of the curve. This is a very important part of the economy that many institutions look at. For example, if you're managing assets for a pension fund and you know that within the next 3 to 5 years, 30% of your employees hit retirement age. Maybe they don't all retire, but they hit retirement age. Got to do it. Maybe you're a life insurance company, and based on actuarial tables, you know you need to be heavy and portfolioed, positioned right here at the 5, 10, this part of the curve. There we go. I'm an auto lender. I'm very, very sensitive to what's going on in this part of the curve. Guys, this is a key part of the economy, the world economy, not just the U.S. economy. And when you can see it expressed like this, that's an easy trade. All right. Now, for those of you who say, hey, I don't care about that stuff. I just want to trade. There it is. Purple below, blue above, short the white. Purple below. You can also short the purple. You're trading 7 contracts instead of 1. Okay. You can long the blue, but you're trading 2 contracts. Or keep it really simple. I'm going to trade the 5-year and make, what is this over here? I'm going to make $500, whatever, $400 on this trade. What's my risk? About 10 ticks. That's $78 per one contract. What's my average return? About $300, let's call it. Okay, so it's a little under, it's a little better than 4 to 1 typical risk. These trades last about 3 to 4 days. If you're not looking at this trade, you're missing out. If you trade one of those prop accounts, this might be just what the doctor ordered, because it's a smooth equity curve. These trades last a good 2 to 4 days, but you can also intraday trade it. The bond market opens at 8:20 Eastern time. Most of these trades you don't want to do until when? 8:33. 8:35. Let me qualify that. On the days where there is an economic report, CPI, NFP, PPI, new housing startups, etc., you want to be really careful. All right. But in the days where there are not, you can trade that at any time. And this is round the clock. So if you are in Asia, you may see this trade develop. If you are in Europe, you could see this trade develop. But if you are in the US, my suggestion is you wait until at least 8:35 to start trading this. But every now and then, I'll say it again, every now and then you come across a trade, you look at it and you say, well, that's easy. Well, not only is it easy to visualize, once you understand how logical it is, how rooted it is in the US economy, you'll thank me later. So that's that for this. If you have any questions or want to learn more about it, it's info@fittrader.io. If you are a member, schedule a time with me. I'm happy to help you, walk you through the entire process, get you started in sim. Once you feel comfortable with this trade, you're going to say, where has this been all my life? It's so easy. Here's the downside, okay? Here's the real downside. It's really boring. It's boring. The profits aren't as crazy and big as, say, some of the options trades or the NASDAQ futures or some of the currency trades. This is a logical, professional approach to extracting money from the market based on a natural condition that exists where yields expand and contract, expand and contract. Now, one thing you want to do is in your country, depending on what country you're in, if you're in the United States, you can trade the futures contract or you can even trade ETFs. There are 5-year ETFs. Bloomberg has one. Vanguard has one. Check with your broker to see what's available there that mirrors the 5-year. If you are outside of the United States, you want to check with your broker what CFD mirrors the 5-year. So there you have it, the curve fly indicator and signal. If after seeing this, you're thinking to yourself, I'm smarter than the average 12-year-old, I can trade this and make money, there's a subscription link in the description section for you to get started. See you on the next one.